Jason, I remember, what was it, a year and a half ago, Bill Gurley was gathering with investors in Silicon Valley saying direct listings are it. They're for everyone. They're the future. I mean, that's not what's happened here. Is it a better public debut and IPO market than it was, though?
Well, I mean, we had an IPO window that was closed for, what, a decade? And the idea that companies would go public, during that 2010 period wasn't even on the table. And we weren't even talking about it in Silicon Valley. And, Bill's been at this for a couple of decades, 3 or 4, in fact. And, we now have this opportunity for companies to go public. We have opportunities for companies to raise money. And what a savvy founder does and what a savvy board of directors does is when the market is hot, you raise capital and you deploy it when the market is not hot, right? And so the smart move is really to raise money now and deploy it whenever there's a pullback. Those dollars that you raise now could be worth 2 or 3 in the future. And we saw that at the dot-com bust. We saw it in 2008 in the Great Recession. So here we go again. We're at a peak market, and it's going to correct at some point. And the smart move is to get public now and to ride it out.
So
now that we have 2 choices, direct listings and SPACs, that's nice that there's
2 more
multiple
choices.
options.
Is it healthy? Is it good? Because, I mean, I see companies coming public through SPAC. It seems to be a lot of the smaller companies usually. I mean, Grab's an exception here. There have been a couple other exceptions. But it's the type of companies that 20 years ago we saw coming public early in their life. And, yeah, ordinary investors had a chance to do some analysis, maybe make a good buy. Like everybody looks now at Amazon. And even Jeff Bezos was touting in his shareholder letter, the couple that bought it really early. I mean, sure, there are a lot of bad SPACs out there, but there's some good opportunities.
Yeah, absolutely. And, people are looking for some kind of alpha, some kind of return. People want to get big returns. People are not interested in making 7 or 10% a year. People want to make 7 or 10% a day, a week. We've kind of lost the script here. And so you have people investing in anything like Dogecoin, Bitcoin, SPACs by companies that have failed. Like I think Fisker failed 2 or 3 times and now they're SPACing again. Like how many times does that brand need to fail for people to not buy the stock? And I'm not dogging just on them. There is a whole cohort of electric vehicle companies that are 2 decades behind Tesla. And now obviously Ford and GM and everybody catching up there. So, buyer beware, do your research. And if you want to play in the private market game, in overvalued SPACs, and many of them are overvalued, you better be in it for the long haul and you better do your research. And now if you're buying Netflix or you're buying Disney and they have 250,000 people subscribing to their, service, you can feel a lot more secure. So this is the great education that has to occur. And that's part of what CNBC and, these online discussions, this is why they're so important, is for us to say Netflix and Disney are different than Fisker and Nikola. It's very, very different. When a company does not have a product in market and they become worth billions of dollars, right, like this company, Theranos, I always save this T-shirt, it could be a fraud. It could be a zero. It could be incompetence. Or, maybe there's a chance that you happen to hit lightning in a bottle.